What's happening, everyone? Today, we are tackling the single biggest question in investing right now, and it's a big one. It's a $10 trillion question. We're talking about the AI war. This isn't just a tech trend, it's a global economic and political battle for the next era of human development. And as investors, we are caught right in the middle, staring at a market that has never been more divided. On one side, you have the United States. You have stocks like Nvidia, which have basically created an entire new category of wealth, soaring to multi-trillion-dollar valuations. The narrative is one of unbridled optimism, of technological supremacy, of hype. These stocks are priced for perfection. On the other side of the Pacific, you have China, you have tech giants like Alibaba and Tencent, once the darlings of the world, now trading in the bargain bin of history. Their stocks are beaten down by regulation, geopolitical tensions, and a struggling economy. The narrative here is one of despair, of risk of a value trap. These stocks are priced for total disaster. So where do you put your money? Do you chase the hype in the US, praying the music doesn't stop? Or do you hunt for value in China, praying the ground doesn't collapse beneath you? Today, we're cutting through the noise. We are going to do a deep dive comparison. We're putting 3 US hype champions head to head against 3 Chinese value contenders. We're going to analyze the bull case, the bear case, the valuations, and the massive unspoken risks for each. This isn't about finding a simple buy or sell. This is about building a framework for how to invest in AI for the next decade. Let's start with the champions, the ones wearing the crown. Let's talk about Team USA and the hype. Our first pick is the undisputed king. You knew it was coming. Nvidia is not a stock, it's a phenomenon. It has single-handedly defined the AI hardware market. The bull case is so simple a child could explain it. AI needs data, data needs processing, and processing needs Nvidia's GPUs. Their H100 and new B200 chips are not just products, they are the picks and shovels in a global gold rush. And right now, Nvidia is the only one selling them. Their market share in AI chips is north of 80%, maybe even 90%, depending on how you count it. But their real durable, long-term moat isn't just the hardware. It's the software. It's CUDA. CUDA is the programming language, the ecosystem that every AI researcher, every data scientist, and every developer spent the last decade learning. You can't just switch to a new chip from AMD or Intel. That would mean rewriting code, retraining models, and abandoning an entire ecosystem. The switching costs are astronomically high. This is why Nvidia isn't just a chip company, it's a platform. It's the operating system for AI, and the market has recognized this. The stock is up hundreds of percent. The valuation is, to put it mildly, breathtaking. We're talking about a forward P/E that is often in the 70s, 80s, or higher, depending on the day. The company is priced to execute flawlessly for the next 5 years without a single misstep. And that is the risk. That is the hype. When you are priced for perfection, anything short of perfection is a disaster. What's the bear case? First, competition. AMD is coming, Intel is coming. More importantly, Microsoft, Google, and Amazon are all building their own in-house AI chips to reduce their dependence on Nvidia. Second, cyclicality. Right now, every company on Earth is in a panic to buy GPUs. What happens when they have enough? AI demand is real, but the rate of growth could slow, and if it does, Nvidia's earnings multiple will collapse. Buying Nvidia today isn't a bet that AI is real, it's a bet that Nvidia will maintain a 90% market share and grow 100% year over year forever. That is a very, very high stakes bet. Next up on the US hype list, Microsoft. If Nvidia is the arms dealer, Microsoft is the first empire to successfully use the weapons. Microsoft's $10 billion investment in OpenAI was perhaps the single greatest business deal of the 21st century. They didn't just buy a stake in a hot startup. They secured the brains of the AI revolution and plugged it directly into the body of global enterprise. The bull case is all about integration and monetization. Microsoft isn't selling AI, it's selling better Windows videos, better Office, and a smarter Azure cloud. Their Copilot at $30 per user per month is a direct, high-margin revenue stream. They are turning AI theory into quarterly earnings right now. They have a captive audience of billions of users and a sales force that already has a relationship with every major corporation on earth. They are the safe way to play AI. They are a diversified cash flow, gushing behemoth that has suddenly found a new explosive growth engine. The valuation has followed. Microsoft is no longer the boring tech stock. It's trading at a P/E multiple well above its 10-year average, locked in a battle with Apple for the title of world's most valuable company. So, what's the hype risk? It's execution. Will companies really pay $30 a month for every employee to have Copilot, or will they just buy it for a few of their developers? Is AI in Word and Excel a must? Have revolution? Or is it just a slightly better Clippy? The risk is that the adoption curve is slower and the revenue is smaller than the market is pricing in. There's also the dependency risk. Their entire AI strategy is built on OpenAI. That relationship, while deep, is also complex. OpenAI has its own drama, its own mission. Any friction there could be a major headwind. And finally, competition. Google's Gemini is deeply integrated into its ecosystem and is fighting back hard. Microsoft has a head start, but this race is a marathon, not a sprint. Third, US hype stock is the new kid on the block, the one that makes Nvidia's stock chart look calm, super microcomputer, or SMCI. This stock has been an absolute rocket ship. It went from a relatively obscure server manufacturer to one of the hottest stocks on the planet, up over 1,000% in a very short time. The bull case. When you buy a $40 100 GPU from Nvidia, you can't just plug it into your desktop. You need a specialized high-performance liquid-cooled server rack to run it, and that's what SMCI builds. Their hype is built on two things: speed and specialization. They are the masters of building blocks. While competitors like Dell or HP take months to design and release new systems, SMCI can design and ship a server for a new chip in weeks. They have a very close relationship with Nvidia and AMD, getting access to new chips early. They are the white box maker of choice for companies that need the absolute latest, most powerful AI hardware. Right now, they are the pure play on AI server demand. The risk is massive. This is the definition of a hype stock. First, what is their moat? Is being faster, durable, long-term advantage, or is it something Dell and HP with their massive scale and supply chains can eventually copy? Second, their business is low margin. They are a box builder. It's a hardware business, and hardware businesses are notoriously cyclical and competitive. Third, customer concentration. A huge chunk of their revenue comes from just a few massive hyperscaler clients. If one of those clients decides to build their own servers or switch to Dell, SMCI's revenue could fall off a cliff. The valuation is pure momentum. It's not based on fundamentals, it's based on a story. The story is powerful, but when you buy a stock like SMCI, you are not an investor. You are a speculator. You are betting that the momentum continues. And when the music stops on a stock like this, it doesn't gently correct. It crashes. So that's Team USA. Nvidia, the platform king, Microsoft, the enterprise integrator, and SMCI, the high-speed assembler. All of them are incredible companies. All of them are at the center of the AI boom, and all of them are priced to perfection. The risk here is not that AI is fake. The risk is that you're paying 2030 prices. Today, if you're getting value from this deep dive, by the way, do me a quick favor. Hit that like button. It's free, and it tells the algorithm that we're talking about important stuff. And if you want to see more analysis like this, make sure you are subscribed. We're just getting to the really interesting part. No, let's cross the Pacific. Let's talk about Team China and the value. The first thing you have to understand about Chinese stocks is that the fundamentals almost don't matter. The sentiment is so toxic, so completely broken, that it's all about politics. We've had a years-long regulatory crackdown from the CCP, a brutal real estate crisis, a common prosperity drive that scared all the billionaires, and US sanctions that are actively trying to kneecap China's tech ambitions. This is why these stocks are cheap. They are not on sale. They are in the clearance. Everything must go bin, covered in dust, and maybe on fire. The value proposition is simple. What if the fire is out? What if the worst is over? Let's start with the big one. Alibaba. Alibaba was supposed to be China's Amazon. It has a dominant e-commerce business, Taobao, Tmall, a massive cloud computing arm, AliCloud, a logistics network, Cainiao, and a fintech arm, Ant Group, that was so powerful the government had to personally step in and shut down its IPO. The value case is a spreadsheet investor's dream. The stock is trading at a single-digit P/E ratio, a P/E of 8 or 9 for a tech giant. It's absurd. The company is sitting on a mountain of cash. Its net cash position and investments in other companies are worth a massive percentage of its entire market cap. When you buy a share of Alibaba today, the market is telling you that its core e-commerce and cloud businesses, the engines of Chinese commerce, are worth almost nothing. The bull case is that the government crackdown is over. The company is now trying to unlock this value by splitting itself into 6 different companies, which could theoretically trade for more than the current whole. They are focusing on AI with their own model, Tongyi Chanwen, and integrating it into their cloud and e-commerce platforms. You are buying a 20-cent dollar and betting that it will one day be recognized as being worth at least 50 cents. The risk. This is the definition of a value trap. The value may never be unlocked. First, the political risk. Is the CCP really done? Or will they find new ways to extract value from big tech for the common good? Shareholder returns are not their priority. Second, competition. While Alibaba was dealing with the government, its competitor Pinduoduo and its international arm, Temu has been absolutely eating its lunch in e-commerce with a low-cost, high-volume model. Third, and this is the big one for AI, AliCloud. The cloud business, its big growth engine, is slowing dramatically, and thanks to US sanctions, they cannot get the high-end NVIDIA chips they need to really compete in the AI cloud war. How can you build a world-class AI service when you're banned from buying the best tools? Our second Chinese value stock, Tencent, if Alibaba is China's Amazon, Tencent is China's Facebook, Microsoft and Activision, all rolled into one. They are the ultimate platform company. Their core is WeChat, which isn't just a messaging app, it is the operating system for life in China. You chat, you pay bills, you order food, you book travel, you get news all without ever leaving this one super app. On top of this, they are the largest video game company in the world. The value case is built on stability and cash flow. Unlike Alibaba, Tencent's core business was less damaged by competition. WeChat's moat is absolute. Their gaming business, while taking a hit from the regulatory crackdown on spiritual opium, is still a gushing cash machine. The stock is trading at a P/E ratio that is at a 10-year low, but the real story is their capital allocation. Tencent is aggressively returning cash to shareholders. They are doing massive multi-billion-dollar stock buybacks. They are also spinning off parts of their enormous investment portfolio. They were early investors in companies like Tesla, Spotify, and Pinduoduo, and giving those shares to their own shareholders as a dividend. They are the safer of the Chinese value plays. You are buying a dominant, cash, rich monopoly at a discount, and management is actively trying to reward you for sticking with them. Their own AI model, Hunyuan, is being integrated into WeChat and their enterprise software, which could provide a new growth vector. The risk is, again, politics. The CCP hates gaming. They see it as a waste of youth. They can, at any moment, impose new restrictions that could kill Tencent's most profitable business. The second risk is growth. The Chinese internet market is saturated. Everyone who has a smartphone already has WeChat. Where does the next billion users come from? It doesn't. Growth has to come from monetizing their existing users more, which is difficult. And just like Alibaba, their AI ambitions are hamstrung by US chip sanctions. Finally, our third Chinese value stock, and this one is the purest AI play of the bunch. Baidu is the Google of China. They dominated search for 2 decades, and just like Google, they have been investing in AI for over a decade, long before it was cool. The value case here is simple. The market is valuing Baidu as a dying search engine and giving them zero credit for their world-class AI assets. When you buy Baidu, you get the search business, which is declining but still profitable for a low price, and you get everything else for free. What is everything else? First, their Ernie bot. This is China's leading, most advanced large language model. It's their ChatGPT, and it's been fully integrated into their search engine and all their other products. Second, Apollo. This is their autonomous driving platform. Baidu is running the largest robotaxi fleet in the world, operating in multiple Chinese cities. This is not a test program, it is a real revenue generating business. So the bull case is that you are buying a pioneering AI and autonomous vehicle company that is disguised as a boring old search company. The stock is dirt cheap. If ErnieBot or Apollo ever gets a valuation that is even 10% of what US equivalents get, the stock will triple. The risk you can probably guess. Sanctions, sanctions, sanctions. More than any other company on this list, Baidu's entire future depends on access to high-performance AI chips. Their ErnieBot cannot compete with GPT-5 or Gemini if it's been trained on last-generation, nerfed hardware. The US government has Baidu in a chokehold. The second risk is monetization. The Chinese enterprise market is not like the US market. Chinese companies are notoriously unwilling to pay high subscription fees for software. So even if ErnieBot is great, can Baidu make money from it? So there you have it. Team China, Alibaba, the deep value conglomerate Tencent, the stable cash flow king, and Baidu, the pure AI gamble, all are dirt cheap, and all are cheap for a very good reason. The risk here isn't valuation. The risk is structural, it's political, it's the risk that your value stock becomes a value trap and goes to zero. So how do we play this? The $10 trillion AI war, US hype versus Chinese value. Here's the bottom line. This is not an either fail scenario. The smart play is about understanding what kind of risk you are buying. When you buy the US hype basket, Nvidia, Microsoft, SMCI, you are taking on 100% valuation risk. You are paying a massive premium for high quality companies, clear market leadership, and the safety of the US legal and financial system. Your risk is that the growth slows and the multiple you pay contracts, causing you to lose 30 to 50%, even if the companies continue to do well. This is a momentum, quality, and growth play. When you buy the Chinese value basket, Alibaba, Tencent, Baidu, you are taking on 100% political and structural risk. You are buying companies at dirt cheap, statistically indefensible valuations. You have a massive margin of safety on paper. Your risk is not the valuation. Your risk is that the CCP decides shareholders don't matter, or that US sanctions permanently cripple their ability to compete in AI, or that the Chinese economy simply stagnates for a decade. Your risk is a 10-year value trap or a permanent loss of capital. This is a deep value, contrarian, and high-risk play. So what's the framework? It's not financial advice, but here's how I'm thinking about it. You cannot ignore the US leaders. In a tech revolution, the leaders tend to keep leading. The hype from Nvidia and Microsoft is built on a foundation of real, explosive earnings growth. You probably need to have some exposure to the arms dealer and the enterprise platform Microsoft. The way to manage the risk is through position sizing. You don't bet the farm at these prices. You also can't ignore China, but you must treat it as what it is, a speculation. You have to size the risk. This is not a core holding. This is a small asymmetric bet. If you have to pick one, Baidu is the purest AI bet. You are betting that the market is wrong about both its search business and its AI business, and that it can overcome the hardware sanctions. The upside is 3-5 times. The downside is 100%. The real war here is defined by one thing: semiconductors. The US hype stocks either make the chips or get priority access to them. Microsoft, SMCI. The Chinese value stocks are being starved of them. This means the value in China is conditional. It only works if you believe they can innovate around the sanctions, that they can create good enough AI on good enough chips for their domestic market. That is the entire bet. And so the $10 trillion question isn't hype or value. It's what's your tolerance for risk. Are you more afraid of overpaying, or are you more afraid of a political black swan? No, I want to hear from you. This is the most important discussion in investing, and I want to know where you stand. Drop a comment below. Are you on Team Hype, believing that US dominance is just beginning and these high flyers have room to run? Or are you on Team Value? And are you brave enough to be buying these beaten down Chinese giants? Let me know which stocks you're buying, which ones you're avoiding, and why. I read all the comments. Thanks for watching. See you in the next one.